Today we will be seeing another accounting standard. Before I tell you what standard we are going to see, let me give you a small example to understand the concept. Let's say X Limited is a company and they are planning to construct a new building. They require totally 100 crores to construct a new manufacturing unit. Now, can you name what are all the expenses they will incur for this construction? Sand, cement, bricks, labor cost, etc. So for constructing a building, you incur a lot of expenses for the building to be ready. How do we account for these expenses? We all know any expense incurred for a fixed asset will be capitalized. So all the expenses for purchase of sand, cement, bricks, paying labor, all interior works, everything will be capitalized. No. They require 100 crores. Assume they have only 80 crores cash which is ready with them. 20 crores of money they are planning to borrow from a bank. Now, they are borrowing from bank only for the purpose of construction of a building. So they have borrowed 20 crores and they will also pay interest on the loan based on the terms and condition of the loan. Now, this amount of interest they are paying, how do we account for this normally? Any interest on loan, we debit interest account, credit cash or bank, and the amount of interest is transferred to your profit and loss account. Now, listen carefully. I will argue saying this interest amount is spent as an expense only for the purpose of construction of the building. Just like how I am spending for purchase of sand, cement, bricks, paying labor for the purpose of construction of the building, similar way this interest is paid for the purpose of construction of the building. I can get 20 crores loan only by paying interest. This amount is used for the purpose of construction of building, and hence I would want to argue by saying I will want to capitalize my interest also, saying this will not be debited to P&L account. Question is my argument valid? Can I capitalize this interest on the loan which was taken for the purpose of construction of a building? So now we are going to discuss a standard called AS16, borrowing cost, which tells any borrowing cost whether it can be capitalized or not. In the previous section, we had discussed what is the background for AS16. Now, every standard has two main parts. First part is the definitions, and second part is how do I account. So first, let's see few basic definitions in AS16, and then we'll move into how to account for the borrowing cost. In the previous section, we had discussed the background of AS16. Now we are moving into the definitions for AS16. The first definition we are going to discuss is what is borrowing cost. AS16 defines borrowing cost as interest and other costs associated with borrowings. Now, throughout the standard, whenever I tell you the word borrowing cost, I would like you to link it to the word interest because it is easier. However, borrowing cost also includes few other points. First, what is interest? When you take a loan, you pay interest. So borrowing cost includes interest. What are the other costs associated with borrowings? Let us explain one point at a time. First is commitment charges. What is commitment charges? I'll give you a small example. Let's say L&T has taken a loan from State Bank of India for 10,000 crores for construction of metro rail. No. Construction of metro is not something which happens in 1 or 2 years. It takes more than 5 to 10 years. Hence, the money of 10,000 crores is required by L&T spread over a period of 5 to 10 years. Will they borrow entire 10,000 crores on day 1? No. As and when they require the money for the purpose of construction, they will borrow money from SBI. But SBI has guaranteed L&T that whenever they ask for money, they will pay this 10,000 crores. They might take it in 100 crores at one time, 50 crores next. Whenever they ask money, SBI will pay. For this agreement, now, for the first 5 years, assume L&T has taken only 2,000 crores from SBI and they still have the limit to take the balance 8,000 crores. Now, will SBI charge interest for L&T on 10,000 crores for the first 2 years or only for 2,000 crores? The question is, loan agreement is for 10,000 crores. However, they have borrowed only 2,000 crores. Hence, interest will be only on 2,000 crores. However, SBI has committed to pay L&T this money. Hence, SBI on the balance amount will charge a very nominal amount, a small percentage known as commitment charges for this money. This is also borrowing cost. Next, let us move to amortization of premium or discount. All of you are aware about the concept of shares. You would have studied in your school in your 11th and 12th grade about shares. Shares can be issued at premium, discount, redemption at premium or discount. There you would have seen a concept. Let's take an example. Share is issued at a face value of 100 and it is going to be redeemed at a premium of 120. So the extra amount you are going to pay at the time of redemption is 20. Only an example. Now, how do we account for this 20? We amortize it over the life of the share. Say it is going to be redeemed after 10 years, preference shares. This 20 will be amortized over 10 years. That is called amortization of premium. Similarly for discount, when you issue shares at discount, now we cannot do it. That amount will be amortized in part of borrowing cost. Next, amortization of ancillary cost. What is amortization of ancillary cost? When a company goes for new public issue, they have expenses like underwriting expenses, prospectus issue, all share issue expenses and similar expenses is incurred for the purpose of getting funds. Therefore, that ancillary cost is also part of your borrowing cost. So far, what does borrowing cost include? Interest, other costs. What are the first three other costs? Commitment charges, amortization of premium or discount, amortization of ancillary cost. The next 2 points relates to two different standards. AS 19. In AS 19, you have heard about a concept of finance charge in a finance lease. That is also covered as borrowing cost in AS 16. In AS 11, we have an important concept where when you borrow money from other countries like foreign currency borrowings and you pay interest in foreign currency, it says exchange difference on foreign currency borrowings to the extent attributable towards interest. That is also covered in borrowing cost. This point, when we deal in AS 11 in detail with a numerical example, it will be explained in AS 11. Now let us move to the next definition. In the previous section, we had covered the definition of borrowing cost. So we had seen what is borrowing cost. Throughout the standard, I want you to think borrowing cost as interest, so it will be easy for you to understand the concepts. Now, next definition is qualifying asset. What is a qualifying asset? The definition is qualifying asset means an asset which necessarily takes substantial period of time to get ready for its intended use or sale. What are the keywords here? Here it says first, borrowing cost is incurred. It is incurred for a qualifying asset. So first we should know what is a qualifying asset. Qualifying asset means an asset which necessarily takes substantial period of time to get ready for its intended use. Now, what are the keywords here? Necessarily means, let us say plant and machinery. Company is constructing a new plant and machinery. So qualifying asset, plant and machinery means an asset which necessarily takes substantial period of time. Let's say your plant and machinery takes 2 years to get ready. Now, if X Limited is going to take 2 years for a plant and machinery, and let's say Y Limited is also going to take 2 years for the same plant and machinery, then it means it is necessary. It means for anybody doing this construction, it necessarily takes them 2 years to get ready for its intended use. Substantial period means the standard does not define what is substantial period. We can assume it to be more than 12 months for the purpose of solving sums. 12 months is a benchmark to get ready for its intended use. Now let me summarize the entire concept. A company wants to construct a plant. It takes them 2 years. However, some other company to construct the same plant, it will take them only 6 months. Is it a qualifying asset? No, because qualifying asset, plant, means an asset which necessarily for anybody doing the job, it has to take at least close to 2 years. Takes substantial period, more than 12 months of time to get ready for its intended use. What is the intended use? I am constructing this plant for the purpose of manufacturing. Intended use or sale. I am constructing this building to sell it. Constructing this property to sell it. Clear, guys? So qualifying asset. Any asset will be called a qualifying asset only if it satisfies this definition. So far what have we seen? First we have seen borrowing cost definition, and next we have seen definition of qualifying asset. Now we will see how the both are linked. So now let us discuss how both are linked. So first step you have to check this. Is your expense borrowing cost? Yes. The minute your item is a borrowing cost, next check if this borrowing cost, if the interest is incurred for a qualifying asset, meaning is this interest expense incurred for the purpose of my qualifying asset? Yes. So once you have incurred interest for a qualifying asset, next you have to check conditions. If it satisfies the conditions, then your borrowing cost can be capitalized. Meaning, I will capitalize my interest along with the asset value so that it will be depreciated over the period of the asset. Now, we will first check what are the conditions. Once you confirm yes, it can be capitalized, next we will discuss how to account for the capitalization and what are the different situations we will face while you are accounting. So, in the previous section we had discussed what is borrowing cost, what is qualifying asset, and we had seen some conditions have to be satisfied. What are those conditions? There are two conditions, specific conditions which are there in AS 16, general conditions for capitalization which is borrowed from AS 10. What is general condition? First, there should be future economic benefits. Having this asset, you are going to get future economic benefits and the cost should be reliably measured. You cannot say, I might spend 10 crores or 20 crores or 30 crores, I am not sure. You should have a reliable measurement of what the cost is going to be spent. This is borrowed from AS 10. In depth, you have already studied about this in AS 10. What are the specific conditions? First, cost to be incurred. You need to incur borrowing cost on the asset. You need to borrow and pay interest for the asset, and you need to spend money for construction of the asset. For a future proposed transaction, you cannot capitalize today. expenditure to be incurred on the asset. You need to spend expense on the asset. You need to purchase raw materials. You need to start construction. Activity should be there on the asset. The asset, assume I purchased land and it is kept idle. Assume you borrowed 5 crores for purchasing land and the land is kept idle for 5 years. Interest on the loan, can I capitalize? No. There has to be some activity on the asset. The activity can be physical activity or administrative activity or some kind of technical activity. What is technical activity? Doing some kind of soil testing. Admin work can be done or some physical work, actual construction. Some activity should be there on the asset. It should not be idle. These are the conditions. If all the 5 conditions are met, then borrowing cost is incurred for a qualifying asset, meets the conditions, then I will go and capitalize my asset. Now how to capitalize, how to account is going to be the next set of discussions. Now accounting treatment, before we get into accounting treatment, there is a small chart which you should know. First, check if borrowing cost is incurred for a qualifying asset or if it is not incurred for a qualifying asset. Accounting treatment of borrowing cost. First you have to check if the borrowing cost is incurred for a qualifying asset or not incurred for a qualifying asset. If it is not incurred for a qualifying asset, meaning borrowing cost is incurred but the asset is not a qualifying asset, then I will expense my borrowing cost, take it to the debit side of my profit and loss account. Where borrowing cost is incurred for qualifying asset, you will further drill it down. Until the time the qualifying asset is ready for use, until the asset is ready for use, meaning until the asset is being constructed or being acquired, being purchased from abroad countries or anything, until the asset is ready for use, I will capitalize my borrowing cost. Once the qualifying asset is ready for use, after this time, you will expense it. Let me explain. Let's say you are constructing a building and the construction has started in 2016 and the construction got over in 2019. Let us assume you have taken the loan for this in 2016, which is repayable in 10 years. So 2026 is when you are going to repay the loan with the interest. So this borrowing cost incurred for a qualifying asset, yes. Therefore, I will capitalize my interest until the asset is ready for use. Qualifying asset. When is it ready for use? 2019. So until 2019, you can capitalize your interest. After 2019, what happens? Asset is now ready for use. You can start using it. Hence, after 2019 until 2026, 2019 to 2026, you will still be paying interest, but the asset is already ready for use. Construction is completed. Hence, this interest now will be taken to debit of P&L. Hence, the conclusion is borrowing cost incurred for a qualifying asset until the asset is ready for its intended use, until the construction is completed. Only until that point you can capitalize, and after that you have to debit the profit and loss account. In the previous section, we had seen when can borrowing cost be capitalized and until what time it can be capitalized. Now we'll see a few cases, past common exam questions. In the previous section, we had seen how to capitalize borrowing cost and until when you can capitalize borrowing cost. Now we'll see few cases which affect the capitalization. Let's say you are constructing a building. Now, because of labor strike, construction has stopped. What to do? Let's say construction is totally 3 years. In the middle, for a period of 6 months, construction was completely stopped because of labor strike. Or let us take, because of the coronavirus pandemic, for 6 months construction is stopped. Now for this temporary halt in construction, during the 6 months, can I still continue to capitalize my borrowing cost? Is the question. Here, the standard tells, is such temporary stoppage avoidable or unavoidable? Meaning, is it within your control? Labor strike, I could have avoided this suspension, which is within my control. Because money was not there, I was not able to construct. All these are avoidable suspension reasons, and hence, during this period, you cannot capitalize borrowing cost. Unavoidable reasons. Example, a flood came, there was a cyclone. Because of all these reasons, because of coronavirus pandemic, because of unavoidable reasons not within my control, then even during this suspension time, you can continue to capitalize. Hence, if the work is suspended and it is avoidable within your control, then capitalization is not permitted. If it is unavoidable reasons, then capitalization can continue. Next, let us see cessation of capitalization. What does it mean? Let us say you are constructing a house for your own personal use. You have constructed the house, painting, everything is over. House is ready. Asset is 90% ready. Small works like finishing coating or fixing a doorknob, these kind of small fittings is pending. But you have already moved into the house or planning to move into the house. So let us take a timeline where at this point asset is 90% ready. Let us say your house is 90% ready to be used. Only small fittings work is left. Can I still continue capitalization or when should I stop? The standard says when the asset is substantially ready for its intended use, then you have to stop capitalization. Do not wait for the asset to be 100% ready to use. Substantially ready means, in this case, house is ready, you can move into the house and live in that house. Small work like fixing doorknob, fixing 1 or 2 screws in few places, it is not relevant. When the asset is substantially ready for its use, capitalization will stop. So now we have covered all the concepts in AS 16. One last concept is pending, which says what rate to use for borrowings. We'll discuss that in the next section. Coming to the last discussion, what rate to use for capitalization, measurement of borrowing cost. For this, let us take a small example. Assume a balance sheet of a company. Let us say the company has a share capital of 100, reserves and surplus of 200, and it has other loans. It already has loans from bank to the extent of 50. Now, for the purpose of construction, of qualifying asset, they are taking a new loan of 100, and they have other creditors etc., which is 100. So the balance sheet total comes to 200, 300, 400, 500, 550. Let's say asset side is also 550. Let's say your fixed assets is 350 and your current assets is 200. Now we have to focus only over here. Let's say for the purpose of construction of the new qualifying asset, company requires 150 rupees. Now already company has loan to the extent of 50 crores, which it has borrowed in the past for the purpose of day-to-day business. So for the new asset which requires 150, I will already use the 50 which is borrowed few years back for the purpose of construction. Additionally, I require more 100, and hence For that I have taken a new loan specifically for construction of this asset. So the standard classifies loans into two types. General borrowings, which is already there in the business for any general purpose, and specific loan, which is taken for construction of qualifying asset. Interest will be paid on this as well as this. Now, what rate should I take for capitalization? It says specific loan, which you have specifically taken for construction of this asset, take that rate. Let's say the rate of interest is 15%. I will multiply 100 into 15%, which comes to 15. This will be the interest amount for 1 year, which will be capitalized on the qualifying asset. So no issue in specific borrowing. Sometimes this entire 100 which is borrowed might be invested in some small short-term funds when the money is not used. Let us say you have earned a small interest of 5% and let's say you earn 2 rupees as earnings. So you will net off 15 is your interest expense, 2 rupees is short-term income earned out of this money. Net of amount 13 will be capitalized. So when it comes to specific borrowings, it is very straightforward. Multiply the amount of loan into the specific interest rate and the amount will be capitalized for the period. If the loan is for 6 months, 6 months period, 12 months, 12 months period. Coming to general borrowings. This general borrowings of 50 can be a combination of multiple loans taken in the past. This is the available book balance today. How do I capitalize this rate? Because this loan of 50 general borrowings might be multiple different loans. One loan of 40, one loan of 5, one loan of 4, one loan of 1. So what do we do for that? I cannot take a standard rate. No. First option. Let's say this 50 is broken down into multiple loans, multiple interest rates. Can I add all the interest and take an average? No. What I have to do is, I will take a new rate called weighted average rate of borrowing. I will compute the weighted average cost of borrowing and that amount rate will be multiplied with by 50. Let us take a small example to see how weighted average cost of borrowing is computed. In the previous section, we had discussed what is a general borrowing, what is a specific borrowing. Specific borrowing, straight away multiply and find the rate. General borrowing, how to find weighted average cost of borrowing. Let's say I have two loans, both are general borrowings used for my qualifying asset. How do I compute weighted average cost of borrowing? Let us assume both these loans are there for entire period of 12 months. So interest on first loan, 5 lakh into 10% comes to 50,000. Interest on second loan, 10 lakhs into 12% comes to 1,20,000. Total interest, 1,70,000. Incurred for total loan of 15 lakhs. Find the percentage, comes to 11.33%. This will be your weighted average cost of borrowing. What you will do is 15 lakhs multiplied with 11.33%. You will get 1,70,000, which is your interest. Now let us say if this loan is not for a period of 12 months, it is borrowed between the year, during middle of the year, only for 6 months, then you will just multiply into 6 by 12, you will get 25,000. Your numerator will now become 1,45,000 and then you will find a new percentage which will be applied for the weighted average cost of borrowing. So this in summary is about AS 16. Thank you.